Rauf, what you could do is that you could download it from the ACCA website. It's also available on the ACCA website, so you can download it from the ACCA website also. Okay, so this is in front of you, the December 2020 past examination paper. What I'm going to do right now is I'm going to um, start discussing about this whole paper. Our objective is going to be that we try and attempt the whole of this paper. So this is what our objective is going to be. Um, Again, a lot of people have got a viewpoint that this has already been examined, so the examiner is not going to examine this again. So why are you going through it? So it's not just about the examiner examining the same thing again. The important aspect is that we should be able to know the recent pattern or the recent trend that the examiner is following. That's an important aspect that you should consider. So I repeat, the important aspect to consider is that the recent pattern that the examiner is following, that is more important thing to do. So from the exam perspective, there are now 3 questions that are examined, and few of you would be attempting the paper on computer, few of you would be attempting the paper on the paper itself. So it's a 3-hour 15-minute paper that it is, and you have to attempt all these 3 questions. Just for your reference, this is the formula that you are being provided in the examination. So these are the formula sheet. Along with it, you are being provided with 3 of the tables. One of them is present value table. The other one of them is an annuity table, and the third one of them is a standard normal distribution table. So this is something that is available to you in the examination. Now see, we're going to start off. The first question that we have is, the name of this question is Kingtim Company. The name of this first question is Kingtim Company. Whenever you come across such big questions, such long questions, so the important thing to do is that to read through the first paragraph or the first section, and then go on to the question's requirement, and then read through the remaining part of the question. So let's start discussing this question. It says Kingtim Company is a nationwide chain of garden centers selling products such as plant, fertilizers, tools, and garden furniture. So what are we being told about this Kingtim Company? That it is a nationwide chain of garden center selling products such as plants, fertilizers, tools, and garden furniture. It was established 20 years ago. It was established 20 years ago by the current team of executive directors and achieved a listing on its local stock market 4 years ago. So the stock market listing has been achieved 4 years ago. Since listing, the company has made consistent profits and has been able to increase its dividend each year. So what happens is, since the listing, the company has made consistent profits and has been able to increase its dividend each year. The executive directors collectively own between 25% of the issued share capital. So the executive directors own 25% of the business. The remaining shares are held by the investors, with none of them owning more than 10% of the issued share capital. So the remaining are by the investors, with each investor being less than 10% or less than or equal to 10%. Now, 2 of the Kingtim's major competitors have been taken over in the last 2 years. So what happens is, in your market, there has been something of a takeover. Media coverage suggests that further takeovers are possible. Potential acquirers include other chains of garden centers, property developers, and supermarket chains. looking to diversify their business into profitable garden center sectors. As yet, no potential acquirer has approached Kingtim company to buy the whole chain, although Kingtim has had inquiries from other businesses wanting to purchase individual garden centers. Kingtim can sell a number of individual garden centers without threatening its continued existence. So, what happens is you have been approached by multiple companies that they want to acquire your different garden centers. You have got different garden centers, so there has not been negotiations or anything to buy the whole chain, but rather the individual garden centers. That is what has been in the business. Now, if I talk a bit further about the requirement to this question, it says discuss the feasibility and effectiveness of the defense strategies of selling off individual garden centers and in enhancing directors' remuneration. So it says what is the feasibility and what is the effectiveness of the defense strategies of selling off individual garden centers and enhancing directors' remuneration. So, for example, what happens is maybe you have got 1, 2, 3, 4, 5, 6 garden centers. This garden center and this garden center are attractive buy for a lot of people, and because of this, the whole business may actually be bought out. So, when you are listed, you have a risk of being a hostile takeover. If you are listed, you have a risk of being subject to the hostile takeover. That's a risk that you face. So you adopt different defensive strategies. So one of the different defensive strategies that they have probably suggesting is that they would sell off these individual garden centers, which is centers like this, centers like this. The second thing is estimate a report for the board of directors of Kingtim company, which estimates the company's cost of capital before new bonds are issued, estimates the market value and yield to maturity of the new bonds, revised cost of equity and revised cost of capital if new bonds are issued, impact of the chief executive's proposal on forecast after tax earning, discusses the impact of Kingtim's cost of capital and the reaction of equity and bondholders to the chief executive's proposal, and so on and so on. So on. So. Then discuss the approach taken to employee remuneration by Kingtim's northern region and the issues associated with it. So there are employee remuneration issues also which are being discussed, and you need to talk about them also. Now take 2-3 minutes, try to read through the question, and then we are going to start discussing. Okay, now let's start discussing. One of them is, it says a takeover defense. So a lot of companies in your business sector have been subject to takeover. So you wish to have a takeover defense. What is that takeover defense? It says Kingdom's executive directors remain committed to the business. They are fearful of takeover, believing that the new owners will want some or all of them to leave the company. So they don't want the business to be acquired by somebody else. So that means what happens is it's more of a job security that they are concerned about. They have therefore been considering possible defenses against a takeover bid. Kingtim Company's chief executive has received two proposals from the directors. Sell individual garden centers which would be particularly attractive to purchasers. Disposal of these centers would make Kingtim overall a less attractive purchase. And this actually does happen. Pay the executive directors higher remuneration and change their contracts so that they would receive much higher compensation for loss of office if their contracts were terminated early. So the second thing is that there are two proposals. One of them is you sell the individual garden centers, and the second one of them is pay the executive directors higher remuneration and change their contracts so that they would receive much higher compensation for the loss of office if their contracts were terminated early. So that's also another type of defensive strategy that they are considering. Kingdom's chief executive believes that, however, that any defense Kingdom company adopts should also strengthen the company's future. She is therefore proposing to expand the current limited sales of campaign products in its garden centers by establishing a chain of Kingdom outdoor shops selling camping, walking, and other outdoor equipment. So she is planning for an expansion. She's like, rather than we going for the defensive strategies and just focusing upon our existing business, what is more appropriate would be is going to be that we, rather than going into the shells, we rather start expanding and we rather start selling uh, more of the camping products. The outdoor retail sector is competitive. So they want to establish a chain of Kingdom outdoor shops. Outdoor retail sector is competitive, but the chief executive believes that Kingdom will be successful. Chain of the outdoor shops would be funded solely by debt. The idea being that changing Kingdom company's finance structure by having significantly more debt would make it less attractive to acquirers. So if I try to see this, it says prepare a report. Sorry, discuss the feasibility and effectiveness of the defense strategies of selling off individual garden centers and enhancing directors' remuneration. So let's try to discuss this. Let's try to understand about this. You see, what happens is this is purely one of those things which you need to do. From the exam perspective, you need to actually ensure that you discuss the key areas. So now see what happens is in the industry we operate, two competitors have been subject to takeover. Our management is committed to continue with Kingdom. The important thing is to avoid potential hostile takeover as only 25% shares are owned by the executive directors and the rest are owned by others. So you can be subject to a takeover bid. You can be subject to a takeover bid. You can be acquired by any company. So that is something that could happen. You could be subject to a takeover bid. That is something that could possibly happen. Now, what happens now is that I repeat, if you could be subject to a takeover bid, what is it that you need to understand? Now, one of the defense bids is to sell attractive garden centers. So with respect to it is that this is very much doable and is a strategy adopted by many entities. This is possible in case if Kingtim has any such centers for which excessive interest has been shown in the past. Kingtim will have to consider if the revenue loss through those centers will be covered through other business or not. So that's one thing that you have to consider. It is a good defense bid. There is no doubt about it. I repeat, it's a good defense bid. There is no doubt about it. The second thing is with respect to the other bid, to the other bid, to the other strategy of enhancing directors' remuneration. With respect to the other strategy of enhancing the director's remuneration, I repeat, with respect to the other strategy of enhancing the director's remuneration, this will be a source of protection as the potential buyer would be concerned about the impossibility or the high cost of change in the management. About the impossibility of the high cost of the change in the management and may not be attracted towards the acquisition of Kingtim. However, this high cost would also be detrimental to the existing shareholders of the company, because if any of the staff members, so if any of the directors is being asked to leave office due to poor performance, then such act will also be and costly for the entity. So do you get it? Yeah, do you people get it? Okay, now let's move a bit forward. So the examiner wanted you to discuss the feasibility and discuss the that whether it is going to be something that is going to help or not. Now let's move a bit forward. So we have understood from here that the takeover bids, I repeat, what we have understood from here is that we have understood that with respect to the takeover, um, this is a potential method of preventing the takeover. Now let's move on to the financial details. Let's talk further. It says Kingtim Company currently has 25 million $1 shares in issue with a current share price of $5.56 per share. So what does the Kingtim Company has? The Kingtim Company has what? They've got the 25 million $1 shares in issue with a current value per share of 5.56. It also has 0.45 million 6.5% bonds in issue. Each 6.5% bond has a nominal value of $1. Each 6.5% bond has a nominal value of $100 and is currently trading at this. The premium on redemption of the bond in 3 years' time is this much. Based on the yield to maturity approach, the after-tax cost of the bonds is 4.1%. It says Kingtim's quoted equity beta for its existing garden business center is this much. Then it says Kingtim Company plans to issue this much new bonds, each with a nominal value of this. These bonds will be redeemable in 4 years' time at a premium of 8%. The coupon on these bonds will be payable on an annual basis. The coupon on these bonds will be payable on an annual basis. These bonds are anticipated to have this rating. The market value of the new bonds is being given. The credit spreads are shown. And it says Kingdom plans to invest the 60 million in non-current assets for the outdoor shops. Working capital requirements can be ignored. Currently, Kingtim's non-current assets have a net book value of this much. It is assumed that the proportion of the book value of the non-current assets, which will be invested in the outdoor shops and the garden centers, will give a fair representation of the size of each business and so on, so on, so. Now, what is the requirement? The requirement is you have to estimate the company's cost of capital before the new bonds are issued, the market value and yield to maturity of the new bonds, revised cost of equity and revised capital of the new bonds, and estimate the impact on the after-tax earning for the coming year. So That is all something that's going to be done from here. So let's try to attempt this. Okay. So now see what happens is it says Kingtim company has 25 million $1 shares in issue. You need to compile the information. What do you have? With respect to the Kingtim company, they have 25 million $1 shares in issue with a current price of 5.56 per share. So with respect to the equity, there are 25 million shares and each share is worth $5.56. So I repeat, with respect to it, it's worth 25 million shares and each share is worth $5.56. So this actually gives you 139 million. It also has 0.45 million 6.5% bonds in issue. With a nominal value of 100 and is currently trading at 104 per 100. So resultingly, what is it going to be? 0.468 million. 0.468 million. So what does it have? It has got 0.45 million bonds. 0.45 million bonds. Each bond is of 100. Wait. Yeah, 0.45 million into 104. So 46.8 it is. So resultingly 185.8. Resultingly 185.8. Now when we talk about this gearing percentage, so it's actually going to be what? 46.8 divided by 185.8 gives you 25.188%. Okay, Yvonne, we are not going to divide it by 100 because if this would have been $0.45 million, then I would have divided by 100. It's not $0.45 million. It's only 0.45 million debentures. So each debenture is worth 104. That's why I have not divided by 100. Now what next is there? Okay, now see, what happens is the premium on redemption of the bonds in 3 years time is 2%. Based on the yield to maturity approach, the after tax cost of the bond is 4.1%. So this bond is redeemable in 3 years time. And whatever there is, you are being told that the cost of debt is what? The cost of debt is 4.1%. And secondly, what happens is it says Kingdom's quoted equity beta for its existing garden center business is 0.9. So the equity beta is 0.9. Next, it says Kingdom company plans to issue. This is what your plan is. To issue 0.6 million, 7.5% new bonds, each with a nominal value of 100. So with respect to the new bond issue, it's 0.6 million, 7.5% new bonds. And each bond with a nominal value of $100. What else is there? These bonds will be redeemable in 4 years time at a premium of 8%. So the maturity of these bonds is going to be 4 years. The redemption will be at premium of 8%. The coupon on these bonds will be payable on an annual basis. These bonds are anticipated to have credit rating of B minus. So they are expected to have triple B minus credit rating. The issue of new bonds will not affect the market value of Kingdom shares of the existing 6.5% bond. So the existing shares, the existing bonds will be unaffected. Okay, what else is there? The market value of the new bonds will be determined by using information relating to Kingdom's credit rating and the 4 bonds which the government has issued to estimate Kingdom's yield curve. All the bonds are of the same risk class. Details of the bonds are as follows. So these are actually the government bonds. These are actually government bonds, or you can call them the risk-free bonds. We are being given the credit spread in the different basis points. So what happens is the relevant yield curve of this bond is going to be 4% plus 0.56% because basis point means 1% is equivalent to 100 basis points. This is going to be plus 0.78%. This is going to be plus 1.06%. This is going to be plus 1.35%. So it's actually going. So the relevant yield curve is going to be what? 4.56%. 5.08%. 5.76%, 6.55%. Now, so this is the relevant yield curve which is available. The plan of investment is 60 million. This is what the investment is, $60 million in non-current assets for the outdoor shops. Currently, Kingtim's non-current assets have a net book value of 150 million. So the net book value of the assets is 150 million. It's assumed that proportion of the book value of non-current assets which will be invested in outdoor shops and the garden center will give a fair representation of the size of the business. So what happens is 60 plus 150, this business now would stand at 210. So you would say that 60 upon 210 and you would say 150 upon 210. So how much is it going to be? 60 upon 210 is 28.5% and this is going to be 71.5% approximate. It says before taking into consideration the impact of this new investment, Kingdom forecast pre-tax earning is coming to be 24 million. So this is the profit before tax, which is coming out to be 24 million. It is estimated that the new investment will make 10% pre-tax return. Corporation tax applicable is this much. So this is the tax rate. Risk-free rate is this much. The market risk premium is this much. So let's try to calculate the existing thing. The number one of them is the existing cost of equity of this company. The existing cost of equity of this company is going to be 4% plus the equity beta, which is 0.9, multiply by the risk premium, multiply by risk premium, which is going to be 9%. Hence, it is going to be 12.1%. That is what it is going to be. If we talk about the WACC of this company, it's going to be 12.11% multiplied by 139 divided by 185.8 plus 4.1% multiplied by 1 minus tax. The tax rate is 25%. Multiply by 46.8 divided by 185.8. So resultingly, what happens is so this turns out to be 9 point, how much is it? 9.834%. 9.834% is what it is going to be. I repeat, what is it going to be? 9.834%. Is this okay to you people? 9.834%. Okay, just let me see if I have made an error here. Is the KD already after tax? Wait. Okay, yes. Thank you for highlighting it. It's an error from my part. Thank you for highlighting it. The KD is already after tax. It's already KD1 minus T. It's not KD. It's KD1 minus T. So it's gonna change a bit. So resultingly what happens is, your WACC is going to be different. Okay, 10.1% approximately. 10.1% is approximately the WACC. I repeat, the WACC is approximately 10.1%. Now what next is there? The next situation is, so we had performed one of the calculation, which was the company's cost of capital before the new bonds are issued. The second thing is market value and the yield to maturity of the new bonds. So if I have to calculate the market value and the yield to maturity of the new bond, so you see for the new bonds, the market value is present value of future cash flows. The market value is present value of future cash flows. You have the year, you have the cash flows, discount factor, and then the present value. What are we being told with respect to the new bonds? The information is 0.6 million, 7.5% new bonds. So it's actually going to be what? $60 million bonds are going to be issued. How much is going to be the redemption period? 4 years. At a redemption of 8%. Now, this is going to be what? 60 into 7.5%. 4.5, 4.5, 4.5. This much is going to be 4.5 plus 60 into 1.08. Because you will be redeeming it at 8% premium. So 69.3 is what it is going to be. The discount factors are going to be 4.56%. 4.56%. The second one of them is 5.08%. The third one of them is 5.6%. And for the fourth year, I have incorporated everything. What have I incorporated? I've incorporated this 6.55%. I mean, like this includes the interest, this includes the redemption amount also. 4.3, 4.075, 3.804, and 53.76. So resultingly, what is going to happen? So resultingly, what is actually going to happen is, resultingly, we will have what? Resultingly, we will have this 65.946 million. 65.946 million. What are we going to have? We'll have this 65.946 million. You get it now? Value of a bond is present value of future cash flows discounted using market rate of interest. So this is what the value of this bond is going to be. Now what next is there? So we have established the market value of the bond also, and you now need to establish the yield to maturity also. So what is this yield to maturity going to be? Let's try to have an understanding of this. When we talk about the yield to maturity actually means the return that you achieve from this bond. So you would have year, you would have the cash flow, the discount factor, present value. Then there is going to be the discount factor, and then there is going to be the present value. So what is actually going to happen is, time period 0, 1 till 4 and 4. So think from the perspective of an investor, 65.946 is what he's going to invest. Okay. The year 4 computation is there's going to be a redemption at a premium of 8%. Okay, if the year 4 is not correct, let me know. You will have interest plus you will have the redemption value. I think it's correct. Okay. Demilair, you are actually missing out one thing, and that is basically the bonds were issued. The bonds that were issued were, each bond was of 100, but the total number of bonds that were issued were zero point 0.7. What they were, what, something like 0.6 million bonds, right? So it's 0.6 million multiplied by 1.0108. That's what the redemption amount is going to be per bond. So 108 into 0.6. See here, zero point 0.6 into 100. That's the total number of bonds, 60 million. Total value of the bond is 60 million. Okay, now what next is there? The next situation is the yield to maturity here is 65.94. 4.5 is the interest, and 60. No, though we have not calculated per bond, we have calculated for the total bonds. If you want to do the calculation per bond, then this is also going to change. If you want to do the calculation per bond, this is also going to change. 64.8. Assume that I'm using 10% as a rate. So resultingly what happens is it's actually going to be 7.4216. I repeat, how much is it going to be? 7.4216. Okay, I got 64.8 like this. It's 60 multiplied 1.08. No, it should not be after tax. No, it should not be after tax. Okay, so what we have is we have 7.4216 as the negative NPV here. If I try to use 5%, so this is what you will have, 3.2856. I repeat, this is what you will have, 3.2856. Now, if you need to calculate the IRR using this bonds thing, so this is your A percent, this is capital A. This is your B percent, this is capital B. The IRR is going to be what? 5% plus. 3.2856. The minus minus is going to be plus. So hence resultingly what happens is this is what it is going to be. 6.535% is what it is going to be. I repeat, 6.535% is what it is going to be. Six point five three five percent is your yield to maturity. Is your yield to maturity. So this is what the yield to maturity is going to be. Okay, I'm just zooming it out so that you could see it. This is how you establish value of a new bond. Time to calculate during workings. I didn't get it. I didn't get it. Kudazanai, I'm sorry, I could not get what you're trying to say. So shall I move forward now? Okay, 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 okay. Okay. So what have we got now? We have got this yield to maturity. Okay. There's a question what yield to maturity exactly means. The yield to maturity means the return that an investor is getting while investing in this bond. So this is actually an average annual return of 6.535% using the discounted cash flows. This is what the investor is getting while investing in this bond. And you could see here that this investor has invested 65.94 at time period 0 from year 1 till year 5. Um, Year 1 to year 4, you got 4.5% in terms of interest. Then in year 4, you got 64.8. So resultingly, what happens is this is the total that you are getting. So annualized return is 6.535. I repeat, the annualized return is going to be 6.535%. Okay, now let's just see. Yes, yield to maturity would be equivalent to market rate of return generally. Now the third requirement was you are supposed to calculate the revised cost of equity and the revised cost of capital if the new bonds are issued. So if the new bonds are issued, what is going to be the revised cost of capital and revised cost of equity? I can guide you with a shortcut way of doing it is that you could say instruments, you could say their market values, you could say their cost in terms of percentage, the cost in terms of dollar. So you've got equity, you've got old bonds, and you've got new bonds. So with respect to the equity, what have you got? 139 million. 46.8 here and 65.946 here. So you can add up all of them. Gives you 251.746. Now see, try to understand this. Uh, the cost of equity is going to be what? 10.1% is the cost of equity. This cost needs to change a bit. I'm going to tell you people. 10.1% is going to be the cost of equity. The 4.1% was it is. Here what happens is you would say 6.535% into 0.75. So resultingly, 3.232. So this is going to be 19.19. Hence, what you could do is that you could say the revised WACC is going to be 19.19 divided by 251.746. So this is actually going to be 7.622%. I repeat, how much is it going to be? 7.622%. So what was your existing WACC? It was 10.1%. What is your revised WACC? It's 7.622. Yeah, do you get it now? Okay, how did we get the cost in terms of dollars? It simply multiplied this by this by this. Yes, while calculating the cost, you have to use the post-tax cost of debt. Okay, this is after the issuance of the new bond, but before this, before incorporating the impact of the KE. So now, what do we need to do? We need to have a revised KE. I mean, because you see, we have not incorporated this. We have not revised the KE. So we need to revise the KE. And now, if we need to revise the KE, so what do we need to do? If you revise the KE, for you to revise KE, you now need to understand that your business is now made up of two things. And what are those two things? One of them is this specific sector, which is the retail, and the other one of them is your existing business. So what do you need to do? The first thing is, what you need to do is that you need to say what is the existing asset beta. So the existing asset beta is going to be the equity beta. How much was the equity beta? 0.9 multiply by the existing market value of equity divided by existing market value of equity plus existing market value of debt 1 minus t. So you get the asset beta to be what? You get the asset beta to be what? So this is actually going to be 0.718. What is it going to be? 0.7185. Now, we need to calculate the weighted average asset beta because 0.7185 is your asset beta of the existing business. And we were being told that the weightage of each business is going to be on the basis of net assets. Sorry, the non-current assets. So it's going to be 150 divided by 210 plus 0.88 multiply by 60 divided by 210. So 0.764 is going to be the weighted average asset beta. 0.764 is going to be the weighted average asset beta of the combined business. So with respect to the combined business, the weighted average asset beta is going to be what? It's going to be 0.764. Now what next is there? We were being told somewhere that the market value of equity will not change or something like that. Kindly look at it. The issue of new bonds will not affect market value of Kingtim shares or the existing 6.5% bond. So that is not going to affect this. Now what happens is the revised equity beta is going to be what? The formula is asset beta is equivalent to, the formula is equity beta is equivalent to asset beta into E plus D 1 minus T divided by E. So the revised equity beta is going to be 0.7646 multiplied by. What is the market value of equity? Try to see this. It's 139. What is the combined market value of the debt? $112.746. Divided by 139. Now it's going to be 1.23. That's what the revised equity beta is going to be. So the revised KE is going to be what? The risk-free rate of return is what? 4% plus 1.23 into 9%. Gives you 15.06%. I repeat, gives you 15.06%. So if I use this 15 point, if I use the revised KE, which is 15.06%, if I use the revised KE, which is 15.06%, the things are going to change a bit. So this actually gives you 10.36%. This is the revised WACC, 10.36%. Yes, it's the old bonds plus the new bonds. That's what 112.746 is. So what have we been able to do? We have been able to calculate the revised cost of equity. Now it says impact of the chief executive proposals on forecast after tax for the coming year. So what is going to be the impact of on the forecast after tax earnings? Let's try to understand this. Okay, you want to see the WACC. Kindly see the WACC. This is the WACC computation. Okay, now the revised working is you have to use this information and you have to calculate the profit after tax. So I'm giving you 2-3 minutes. Try to attempt it. Try to attempt the revised profit after tax. Yeah, are you people done with this calculation? This is what you have to calculate. Okay. That's why I was a bit reluctant to give you people a bit of a time because usually the results don't come in. Now, see, so we already have the profit which is being told, we are being told 24 million, right? So if we have to calculate the profit after tax, the existing profit before tax is 24 million. And the new investment will make 10% pre-tax return. Profit before tax from new investment. 60 million into 10%. So gives you 6. That makes it 30. Then what else is there? The interest cost needs to be deducted. What is going to be the interest cost? There is an old loan, there is a new loan. So 7.5% into 60 million. And the old loan was, how much was the old loan? 6.5%, and it was 0.45 million, right? So what you end up getting is profit before tax. This is 22.575, and then you apply tax at the rate of 25%. So you end up getting 16.93 as the profit after tax. I repeat, you end up getting 16.93 as the profit after tax. Yes, Kotas and I, that's really good to see that you have done the calculation. For the rest of you, this is how the calculation is going to be done. Yeah, for the rest of you, this is how the calculation is going to be done. Aisha? We are not being provided with the depreciation details, Bene. So that's why we can't do this. Okay, shall we move forward now? Now, the next requirement to this question is, it says, discusses the impact on Kingdom's cost of capital and the reaction of the equity and bondholders to the chief executive's proposals. The discussion should include an explanation of any assumptions made in this estimate. So, what is actually happening over here? The impact on cost of capital is that WACC has increased. This is largely because of increase in the K, which in turn is because of the increase in the business risk as evidenced by higher higher asset beta for the retail business. So one thing is, this is what the impact on it is. The asset beta shows to you the business risk. Now, with respect to the equity holders, what are the equity holders going to consider? They were existing profit before tax was 24 million. The existing profit before tax was 24 million. So if I say this 24 million divided by the existing value of the equity was what? 139 point something, right? So it was 17.2%, the PBT. From the perspective of the equity holders, what do you need to do? You need to calculate that what was the existing return on equity. So for the existing return on equity, what do you need to do? You need to say that 24 million minus 45 million into 6.5%, and then 75% because you have to have the after tax. So 15.8 million was what it was. The market value of equity was 139.8, right? How much was the market value of equity? 139. So the return on equity is going to be what? 11.366% is what the return on equity is. And this is after tax return. The additional return is what? The additional return is what? 16.93 minus 15.8 is 1.13. And what is the investment that's being done? So you have taken a loan which is worth 60 million. So it's only going to be 1.88% on the additional return that has been the additional investment. So generally speaking, okay, 45 is the existing loan because it was 0.45 million into 100. So what would happen here is that you would say that the equity holders would not be happy as the new investment is not generating excessive return and has resulted in increase in increase of the business's risk. 16.93 is your revised profit after tax. I mean, there could be other ways, multiple ways of doing the calculation. I've used this 16.93. Now, with respect to the bondholders, if I talk about the bondholders would be concerned that the project in which investment is made is not a huge project and rather, so the bondholders would be concerned that the project in which the investment is made is not a huge project, rather the entity has existing bond providers to settle also. So in case of any defaults, the amount available for settlement would be distributed amongst greater stakeholders. So the likely recovery of amounts will be in doubt. So this is what the bondholders would be thinking, that the likely recovery of the amounts would be in doubt. The next part of this question is about the approach to employee remuneration taken by Kingdom's northern region and the issues associated with it. So let's try to discuss that, what has been the approach taken and what are the issues. So it says that Kingdom's annual report contains a general commitment to act with a social responsibility. Yeah, here it is. Okay, now see, um, it says Kingdom's annual report contains a general commitment to act with social responsibility in line with society's expectations. It also commits to paying its staff fairly in accordance with their responsibilities, and it states that its staffs are vital to its success. So, what is it? They say that we are socially responsible citizens and we look to paying their staff fairly in accordance with their responsibilities. Uh, to try to improve situation of low paid employees, government has recommended a basic hourly wage as the minimum level employees should be paid. Although this minimum is not legally enforceable, a newspaper investigation has revealed that some of the staff in Kingdoms, garden centers of the northern region are paid up to 15% less per hour than the recommended minimum wage. Most of these staff are part-time staff working limited hours each week. Manager, when asked to comment, stated Kingdom had obligations to its shareholders to control staff costs. Lower pay levels were necessary to differentiate between staff, ensuring managers with experience and expertise were appropriately rewarded. Manager commented that pay levels also reflected the lower commitment to Kingdom company which part-time staff made compared with the full-time staff. So what have they been up to? They are doing this thing that they have not been paying good amount to the part-time staff, and they've been paying good amount to the full-time staff. Now see, it says what is going to discuss the approach taken to employee remuneration and the issues associated with it. Now see, what happens is the existing approach to employee remuneration by Kingdom has certain factors which need to be considered and taken into account. The number one of them is what? The number one of them is what? Um, it is fair that experience, commitment, loyalty be rewarded. But it is wrong to comment that part-time are less committed as compared to full-time, as part-time staff may give their full effort during the limited time that they work. The third one of them is, if we underpay, this will have multiple impacts. Staff will be demotivated. Staff turnover will increase. Reputation will be damaged amongst public and potential employees. The ethical issues also arise that in order to support returns to shareholders and to retain their employments, directors paying are underpaying to employees, which will also damage the reputation of entity and may lead to loss of customers. So these are the multiple things that are actually going to happen. I repeat, these are the multiple things that are actually going to happen. Yeah, sorry, I missed out this one. The assumptions have to be mentioned in B5. So we are done with this question, the name of which was this Kingtim company, a recent exam question worth 50 marks. I repeat, recent exam question worth 50 marks. Okay, here you go. This is the answer screen. Okay, so we are done with this question now. The name of the